in right now to talk about all that went on with respect to the FOMC meet. Many thanks for joining in. The Fed minutes clearly showing an extensive discussion of the market conditions, talking about the balance sheet reduction ending and highlighting the risks to the downside on the economy. How have you read into the kind of commentary that has come about, Geoff, and the kind of move that we've seen on Wall Street?
I think the Fed minutes actually really confirmed that the Fed is kind of confused about exactly where monetary policy should go from here, and this is perhaps why Chairman Powell was obviously more cautious about effectively calling for further rate hikes when the meeting occurred, obviously last month. There's a lot of, I think, a lot of counter moves of all sorts which could impact the Fed. I think the most important thing, though, and I think this is probably why the market has treated this whole episode relatively well, is that there is some uncertainty about the global economy, particularly the further slowdown in China. Of course, the European numbers have also been very weak of late, and some clear evidence the U.S. economy will slow. So I think it's a very open question what happens from here, and I think the Fed decision in January, commentary, and the minutes sort of confirm the sort of uncertainty the Fed is feeling.
And it doesn't really give you a good signal, Geoff, because if I look at the contours, they're saying that there are downside risks to the U.S. economy. So it's obviously that assumption that they're willing to go soft on interest rates.
I think that's absolutely right. Clearly, if we take it the other way and the U.S. economy is very strong again in 2019 and we get back to concerns about inflation, I think you'll see rate hikes being resumed, and that is not impossible. But most commentators believe the economy will slow. There's very good reasons for that. Global economy slowing, the ongoing impact of the trade war with China, the rolling off of the tax cuts from last year. All of that means the U.S. economy will slow. And I think it's a question of the Fed trying to assess what is the extent of the risk to the economy. Are we actually moving into a sort of recession risk, which I think is still probably relatively low? And until the Fed's got a better signal for this, I think they're going to stay pretty, what should we say, they're going to stay very much dependent on how this data and all these other indicators play out. I mean, we had a massive sell-off, of course, in U.S. equities, global equities in the fourth quarter. They're not reacting to that. I don't think they're reacting to that generally. They're saying, are the global equity markets telling us something about the U.S. economy, the global economy? And that's what they're reacting to. And frankly, they're not very sure. And I don't blame them, to be honest.
Right. A confused rhetoric, while the slow growth has been in the market for some time, and the Fed now is joining in and moving away from the kind of rhetoric that they've had in the past. Geoff, thanks very much for joining in and giving us that perspective.